Hey everyone, in this video, I'm going to bring you one growth stock that's down 76% off its highs and one that I think is an excellent buy for 2024 and beyond. So I'm going to share with you what this growth stock is, the financial metrics that I appreciate, and why I think it makes an excellent investment. So let's jump right in, see what the stock is, and look at the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the stock that I'm talking about is JD.com. It's down 76.23%. JD.com is one of the leading Chinese e-commerce companies, and that's one of the reasons why the stock price is down so much. Investors are becoming sour on Chinese stocks, and on top of that, the Chinese economy is growing much slower than was expected. So those combination of factors are bringing down JD.com stock, but I'm going to argue that that's more than reflected in the stock price, and I'm going to argue that it makes an excellent investment at current valuation. So let's start taking a look here. Revenue over the last decade has grown meaningfully from less than 50 billion, from less than 25 billion all the way up to 152 billion. But you could see revenue growth has somewhat plateaued here since the economic reopening gained momentum around 2022 and late and early 2023. So this is something that JD has to work on. And in fact, I'll show you that analysts do expect JD.com to start increasing revenue in 2024 and 2025. Additionally, JD.com has demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from $100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. Now that you know what economies in scale refers to, you can see JD.com operating profit margin for the trailing 12 months. Look at it rising nicely over the years from negative 6% all the way up to 2.78% in the most recent trailing 12-month period. Now let's look at what analysts expect from JD.com over the next 2 years. So for fiscal year 2024, which ends December 2024, JD.com is expected to grow revenue by 6.9%, and that increase in revenue is expected to generate a 10.6% increase in earnings per share. Similarly, in 2025, it's expected to grow revenue by 6.7%, which is expected to fuel an earnings per share increase of 14.9%. So increasing earnings per share, increasing revenue by mid-single digits for JD.com. And given its already massive scale, we noticed over 100 billion in revenue. That's going to generate solid growth for JD.com. In addition to nice growth prospects for the next 2 years, JD.com's balance sheet is in strong position. It has 33 billion in cash and short-term investments and only 6.37 billion in long-term debt. That means JD.com can pay off its long-term debt and still have roughly 25, 26, 27, roughly billion dollars available even after it pays off all its long-term debt. Now, it doesn't need to, but if it chooses to, it can do that and still have all that money left over. Before I get into JD.com's valuation, I want you to consider the price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. So now that you're aware about the price to earnings ratio and what it means, you can see here JD.com is selling at an relatively cheap valuation at a forward price to earnings of 6.632. That's the cheapest this stock has traded for going back all the way to 2020. Investors have not been able to buy JD.com stock at a cheaper valuation than they have now. Admittedly, current risks are higher than they were in the last few years. China's economy is growing slower than it has in the last few years. JD.com's revenue growth has seemingly plateaued in the last couple of years. And so you can understand why investors are not willing to pay as much of a premium for JD.com stock. But I think that's an opportunity for investors to buy this stock at this depressed valuation, especially. Remember, if you've been following my channel, what's the thing I like to say about earnings per share growth compared to price to earnings ratio? I always say that I like when stocks have earnings per share growth for the next 2 years that's higher than the valuation, right? So what you see here is earnings per share is expected to grow by 10.6% and 14.9%. And when you look at the valuation, it's only at 6.6. So you're getting EPS growth much higher than the forward PE ratio. I really like that. I think that's an attractive characteristic of an investment. And so for that reason and the many others that I've highlighted, I think JD.com makes an excellent investment for growth stock investors in 2024 and beyond. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.